We are less than a month away from the end of the financial year, which means we are approaching one of the hard dates we have when it comes to tax, because there are certain things that you need to do before the financial year ends if you want them to affect this year's tax returns. Here are my top 5 for business owners. The first one is to write off bad debts. No one wants bad debts. In an ideal world, we collect every single invoice that we sent out, but that's not always reality. So coming into the end of the financial year, it is a great time to review your current outstanding debtors. You should be looking at who owes you money and are you actually going to collect that money. If you're not going to collect that money, now is a great time for you to write off that as a bad debt, so you're not paying tax on that income. So with those ones you're writing off, these are going to be the ones that you just feel like you're definitely not going to collect. Maybe the person's going out of business and you know there's no chance you recollecting those funds, or you just know it's a lost cause. Now, if the odd situation does happen where you do recover these bad debts, you can bring them back in as income in a future year. While you're doing this, try and put in processes so you don't end up in a situation with bad debts. Obviously, the ultimate goal is to have no bad debts to write off because you've collected all of your money up front and you've had no issues when it comes to collecting payments. The second one is do some tax planning. If you haven't already, do some tax planning. I'm going to keep saying it, do some tax planning. You should be looking at an estimate of what is your current taxable income likely to fall at, what's the tax liabilities on that, and are there any strategies you should be putting in place prior to the end of financial year that's going to help optimize your tax position. Whether this is looking at things like writing off those bad debts that we just talked about, prepaying some expenses, deferring some income, purchasing some assets. There are a lot of different strategies that you could be putting in place to optimize your tax position, and some of these will need to be done by 30th of June for them to have that impact. Sometimes it's also just about knowing where you're at. If you do some tax planning and know, hey, I'm going to end up with a $30,000 tax bill, at least if you're looking at this time of the year, you have almost 12 months before that bill will be due. So now you've got 12 months to plan for this. You can start to put together a schedule of tax payments of when things are going to be due over the next 12 months and ensure you're putting the cash away. Something I like to do with my clients is look at what has there been their top line revenue, what's their estimated tax, and what does that look like as a percentage of revenue. And then they can start putting away that amount on an ongoing basis to ensure they're covered from a tax point of view. Now, the third one is for those that are with trust, and you need to make sure that you've got your trust deed distribution resolution done by the 30th of June or whenever your trust deed states. This is super vital because if you do not have this document in place and signed by the date that your trust deed says, then you will potentially be paying tax at the highest possible tax rate, which you do not want to be doing if it can be avoided by simply filling out one piece of documentation. This is a distribution resolution that states how you're expecting the trust income to be allocated to the beneficiaries. And typically, if this isn't in place, it means the trustee will pay tax, and the trustee pays tax at the highest possible marginal tax rate. So it's obviously something you want to avoid, but it's a very easy fix by getting this document done. Now, you don't have to use fixed amounts. You can typically use percentages. You need to read your trust deed to make sure it allows for that. You can also do what they call streaming of income if your deed allows it, where you can allocate different amounts to different people depending on what type of income it is. It's a great tool as a part of the tax planning process, but you need to get it right, and you need to get it right for your trust deed. Obviously, this is where you want to get your tax planning done as well, because then you can get these allocations done at a tax efficient manner. And all of these things are things I've been reminding people as a part of my free email newsletter, where I'm dropping tax tips every single week to you guys and reminding you of these key deadlines that come up and how you can be best optimizing your position. I'd love for you to join that one. The link is in the description to this video. Now let's move on to the fourth one, which is super contributions. If you're considering putting money into super, then you obviously need to act on that now before the end of the financial year, and you need to act on that quickly because the cutoff dates are coming up quicker. And that's because the funds will typically have a cutoff date, which is prior to 30th of June, when they need you to get the funds to them so they can get it processed in this current financial year. Now, making a super contribution is a personal decision, and you should seek professional financial advice from a financial planner to ensure it is correct for you. But it is also important that you understand the tax implications of making a super contribution. So if you make a concessional super contribution, you fill out a notice of intent to claim, then you'll be able to claim that as a deduction in your tax return as long as you meet all the other eligibility. One of those key eligibility requirements is the limit. So there is a concessional super contribution limit of currently $27,500 that is going up in future years. There is also the ability to use the carry forward from prior years where you haven't utilized all of the limit. So it can be a great way to utilize super contributions as a part of an overall tax planning strategy and a financial planning strategy. And obviously, to seal the deal on these, you need to make sure you do fill out a notice of intent to claim so that the ATO have those details, so then when you claim it in your tax return, the return gets processed successfully. And then the fifth one is prepaying expenses. You can prepay expenses for up to 12 months in advance and claim them on your tax return this year. So this is a really handy tool that businesses can use when they've got a year where maybe their taxable income is higher than a future year. So for instance, maybe you've sold some property as well this year, or you've had a really good year from business and you know income's going to be high and you're looking for a way to bring it down because maybe you're on the highest marginal tax rate now and you want to get back into the lower ones. Well, maybe you're going to prepay some expenses. Maybe you can prepay your accounting fees, or maybe your insurances. And maybe you can even get a bonus where maybe you're paying some kind of subscription for 12 months advance. And because you're paying on that annual tier, you're getting a discount just by paying it annually. So it can be a double whammy approach where you're getting a discount as well as a tax deduction in this current year. Just remember though, that this could bite you a little bit next year because if you prepay for something now, it means you haven't been paying it for next year, but you might be in a position where you can go and prepay for the next year. It just depends about where your income's going to fall. And that's why having an idea of what your current taxable income is for this current year and for potentially for future years allows you to do some more longer term planning. There were some key tax changes in the budget this year, including one that does impact businesses. I've done a full video on that in this upcoming video where I go through the key tax and super changes that happened in this year's budget. I'd love to see you over on that one and I appreciate you watching this one.